Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze ARM holding stock. I'm going to talk about whether ARM stock is one of the best AI stocks over the long term. More importantly, I will talk about whether I think ARM holding stock is undervalued, fairly valued, or substantially overvalued now. As always, I like to give you more context first. ARM became a public company again in September 2023. When it went IPO in September 2023, the company's market value was as high as 62 billion. Now, at the time of making this video, ARM's market value is nearly 190 billion. This is over 3 times ARM's initial market value. One of the biggest reasons is that ARM is benefiting a lot from the current AI boom. As you may already know, ARM has a monopoly in the smartphone market. ARM-based processors and SoCs are in 99% of smartphones, such as iPhones and Android phones, and in most tablets such as iPads and Android tablets. Going forward, investors expect that ARM's revenues and net profits will likely grow much faster than before because of higher licensing fees and high royalties from ARM-based chips. Of course, we have to be realistic at the same time. Right now, many AI stocks have grown much faster than their expected earnings growth. So in this video, I will explain whether I think ARM stock is substantially overvalued now. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about ARM Holdings' biggest risks to consider, ARM's long-term growth prospects, ARM stock valuation, and will I buy ARM stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings. The link is in the video description. Take a look, let's start. At the time of making this video, the market as represented by the S&P 500 is dominated by the mega cap tech stocks. In fact, the Magnificent Seven stocks, Nvidia, Microsoft, Apple, Google, Amazon, Meta, and Tesla make up about 30% of the S&P 500's market value. Currently, the S&P 500's year-to-date return is around 70%, but most of the S&P 500's year-to-date return is from the Magnificent Seven stocks. According to the Wall Street Journal, the Magnificent Seven stocks are responsible for about 60% of the S&P 500's total return this year. Without the Magnificent Seven stocks, the S&P 500's total return would be much lower this year. According to Yahoo Finance, analysts have estimated that the S&P 500 companies' earnings will continue to recover throughout 2024 and the first half of 2025. This means the market will likely recover more going forward, but a large percentage of this earnings growth will be coming from the mega cap tech stocks, especially from the Magnificent Seven stocks. So what does this mean to you? Going forward, it means that your portfolio will likely underperform the S&P 500 if you don't have a large exposure to the largest mega cap tech stocks. These Magnificent Seven stocks as a group are the best and most competitive companies in their industries. Most of them have very large economic moats. Most of them are near monopolies. They generate the most profits and most free cash flows compared to competitors. They are benefiting the most from the current AI revolution. So naturally, I believe they will likely outperform the S&P 500 at least throughout this year and perhaps throughout next year. I want to show you one of my stock portfolios before talking about ARM holding stock. I always show this portfolio in my investing videos to explain my investing strategies over time. This portfolio is separated into 3 different accounts. This is the first account. This account is performing exceptionally well. It's outperforming the S&P 500 by a very large margin because I mainly invest in the best mega cap tech companies that are the best in their industries. You can see that there are several multi-bagger stocks in this account, such as Microsoft, MasterCard, Visa, Amazon, TSMC, and Google. I bought them when they were much more undervalued before. Last year, if you have been following my channel, You may remember I said that it's best to keep investing in the Magnificent 7 stocks because they are the best and most profitable companies in the S&P 500. I've been right so far. This is the second account. This account is also performing exceptionally well compared to the S&P 500. There are several multi-bagger stocks such as Apple, Google, Microsoft, Visa, and TSMC. I made the mistake of selling Nvidia for a quick profit before, so I bought back more Nvidia earlier this year. I will likely buy back more Nvidia going forward. I'm just waiting for a large dip. This is a third account. It's a much newer account than the other two accounts. I bought many of these stocks over the past 1.5 years, so it will take time for them to become multi-bagger stocks. Recently, Tesla and Salesforce have recovered a lot. I decided to sell some Tesla shares for a very small profit because I wanted to use the money to invest in other companies. I'll probably regret selling Tesla too early again. I expect Tesla will recover even more once interest rates are much lower in North America and once the entire EV market starts recovering. Overall, I expect that most of these companies will grow exponentially over time because they are the best and most profitable businesses in their industries. Most of them, such as Microsoft, Nvidia, TSMC, Google, Amazon, Synopsys, Meta, and Broadcom, are benefiting a lot from AI. Let's go back to ARM Holdings. I think it's very important to understand ARM's business model and its biggest risk first. So what's ARM and how does ARM earn its revenues? ARM Holdings is a British semiconductor and software design company. It is known for developing the ARM architecture, which is widely used in 99% of smartphones and tablets, and in many Internet of Things IoT devices. ARM processors are also found in many electric vehicles, embedded systems, and increasingly in servers and AI supercomputers. ARM processors are most popular in mobile devices because they are generally much more power efficient and still have very high performance per watt compared to x86 processors that are made by Intel and AMD. Here's the important part about ARM's business model. ARM specializes in designing microprocessor IPs. ARM does not manufacture its own chips. Instead, ARM licenses its chip design technology to other companies, which then produce the physical chips. ARM's designs are based on reduced instruction set computing RISC principles, which emphasize efficiency and performance. ARM earns its revenues from two main sources, licensing and royalty. At the time of making this video, license revenue contributes about 45% of ARM's total revenues, and royalty contributes about 55% of ARM's total revenues. Going forward, royalty is expected to contribute the most revenues to ARM over the long term. I'll talk more about this throughout this video. Here's how it works. First, ARM licenses its processor designs and other technologies to semiconductor companies, OEMs, and system integrators. These licenses allow ARM's clients to manufacture chips based on ARM's designs. Customers need to pay ARM licensing fees to use ARM's latest chip designs and IPs. Second, in addition to licensing fees, ARM earns royalties from each chip produced that uses its ARM designs. This means that for every device that incorporates an ARM-based chip, ARM receives a small percentage of the selling price or a fixed amount per unit. According to Morningstar, ARM's royalty rates for its newest architecture, V9, are around 4% to 5%, which is double those of its predecessor, V8. For the older architecture, ARM earns about 1% to 2% of royalty fees from every ARM-based chip that's sold. For the newest ARM V9 architecture, ARM earns around 4% to 5% from every ARM-based chip that's sold. As long as ARM is continually innovating, investing in R&D every year, and introducing newer chip architectures that are more performant and more power efficient, ARM will earn high royalty fees and higher licensing fees from its customers over time. Here's ARM's biggest risk we should consider. ARM's royalty revenue is largely dependent on smartphone sales, the automobile market, and the overall semiconductor market. ARM earns a very large percentage of royalty revenues from Apple, Qualcomm, Samsung, and many Chinese smartphone makers. Right now, the smartphone market is slowly recovering, but if there's a huge correction in the smartphone market, such as in 2023, ARM's royalty revenue would decrease by a lot. The same thing applies to the overall semiconductor market. If there's a large correction in the semiconductor market, we can expect that ARM will earn lower royalty revenues from the Internet of Things IoT devices and consumer electronics that use ARM-based processors. This is the second risk we should consider. ARM's gross margin is exceptionally high. ARM's gross margin has been well above 90% for many quarters. ARM's operating margin has been above 40% in recent quarters, but this is not the full story. I think these non-GAAP margins are a bit misleading. Let me explain it here. If you look at ARM's most recent annual report, you will see that ARM's GAAP operating margin was only 3.4% in fiscal 2024, but its non-GAAP operating margin was much higher at nearly 44% in fiscal 2024. So why was there a huge discrepancy between ARM's GAAP operating margin and its non-GAAP operating margin? ARM's biggest operating expense is research and development or R&D. Every year, in order to stay competitive, ARM has to invest at least 30% of its total value in R&D, which is very common for fast-growing companies. Stock-based compensation is the biggest expense within R&D. ARM has to pay a lot of stock options to employees, mostly engineers, every year, in order to develop better chip designs, IPs, and chip architectures for customers. In fiscal 2024, ARM's actual R&D was around 61% of the company's total value, which was extremely high. Excluding these stock-based expenses, ARM's R&D was around 35% of the company's total revenue, which was still very high. Stock-based compensations are non-cash expenses, but they are still real expenses to the company. ARM's management decided to pay employees a lot more stock options instead of cash, because it would make the company's non-GAAP operating margins and free cash flow margins much higher. Of course, this is a very common practice for many fast-growing companies, but I think this is a bit misleading for investors who don't study accounting. This is my prediction. Going forward, I believe ARM will invest at least 30% of its total revenues in R&D each year, because ARM wants to stay competitive and release better architectures and chip designs earlier. So that means ARM's GAAP operating margin will likely stay very low in the single-digit percentage over the next several years. I want to show you these financials here. I believe ARM has a strong balance sheet. At the time of making this video, ARM has around 2.92 billion of cash equivalents and short-term investments. In comparison, ARM only has around 231 million of operating lease liabilities. This means ARM can pay off its operating lease liabilities in advance and still have 2.7 billion of cash left. When it comes to investing, we also need to look at stock valuation. It doesn't make sense to overpay a stock, no matter how much growth potential the business has. According to analyst estimates here, ARM's value is expected to grow anywhere between 15% and 25% each year over the next 5 years. ARM's EPS is expected to grow faster than its revenue growth over the next 5 years. Here's the important part. At the time of making this video, ARM's forward PE is well above 100. If ARM's EPS grows at these rates, ARM's forward PE will still be slightly above 50 5 years from now. This is from Seeking Alpha. ARM's forward PE is expected to be above 110, and its forward PE is expected to be almost 60 around 4 years from now. I think this forward PE suggests that ARM stock is substantially overweight now. This is another risk we should consider. SoftBank is still the largest shareholder of ARM. SoftBank owns approximately 88% of ARM. This means SoftBank still has nearly 100% control of ARM. Investors like us will have no control over ARM's growth strategies, even if ARM is paying too many stock options to employees at the expense of margins. In terms of competition, ARM's biggest competitors are x86 architecture, which is owned by Intel and AMD, and open source RISC-V architecture. This is from Morningstar. The analysts here did a great job explaining ARM's biggest competitor, RISC-V. I don't think the RISC-V architecture can disrupt ARM's chip design and IP business in the long run, because it's very costly and time-consuming for large chip makers and large chip designers to switch their architectures from ARM to RISC-V. Time to market is very important for the largest chip designers. ARM's ecosystem is much larger than RISC-V. ARM's ecosystem is well supported by millions of developers around the world. ARM-based processors are generally much more powerful and more energy efficient than RISC-V chips. RISC-V architecture is the main challenger to ARM, just as ARM is a challenger to x86 in the data center. RISC-V is a very simple and open source architecture where developers can modify the architecture without having to pay an architectural license. This allows startups to save costs and have more freedom, but in exchange adds engineering complexity and a longer time to market than directly licensing ARM. ARM also provides centralized customer support and cybersecurity, whereas in RISC-V, support is scattered over the ecosystem, and you may have to find a solution yourself. Architectural license fees are a small part of a chip design cost, around 15%, so in our view, established players have little incentive to switch to another architecture just to avoid paying a few dollars per chip to ARM. For startups, the rationale is different, as the architecture is one of the first expenses you face when developing a new chip, and going for a free option might be worth it. Hence, we believe RISC-V will remain a challenger in cheaper, less critical applications, given it's a young ecosystem that still needs to develop technically and economically. The RISC-V ecosystem is growing and gaining support from established players, but its CPUs cannot match ARM in power efficiency, performance, and customer support yet. Even if RISC-V would manage to disrupt ARM in the long run, this process could take a long time, which gives us confidence in our wide moat rating. Let's talk about ARM's long-term growth prospects so you will know whether ARM is one of the best AI companies for long-term investing. I want to show you this revenue guidance from ARM's management. ARM's management expects that the company's revenue will grow by about 22% year-over-year in fiscal 2095. Over the longer term, ARM's management expects that the company's total revenue should grow at least 20% year-over-year for each of the fiscal years ending in 2026 and 2027. This means we can expect that ARM's total revenue will likely grow at least 20% year-over-year over the next 2 to 3 years. I believe this revenue growth guidance is reasonable for ARM because of several growth catalysts. Management explained these growth catalysts that are benefiting ARM now. Growth will be driven by royalty revenue. We expect the demand for ARM-based compute to continue across all market segments, especially as AI is developed in virtually all applications, from the most advanced data centers to the smallest edge devices. All this extra compute requires increased performance with less power consumption, which is driving the need for ARM's most advanced technology, such as ARMv9, into smartphones, servers, smart IoT, and networking devices. Chips based on ARMv9 technology now contribute around 20% of royalty revenue, up from around 15% last quarter. Growth will be driven by the need for more energy-efficient compute and AI capability from the data center to edge computers. As the amount of compute to run these complex AI workloads is increasing exponentially, the amount of energy required will increase too. According to a 2023 report from Boston Consulting Group, US data centers already consume around 126 terawatt hours per year, and this is expected to rise threefold by 2030. ARM's data center customers are reporting substantial performance per watt savings compared with legacy architectures, and this contributes to why ARM's energy efficient technology is being chosen to help run these workloads. Google recently announced its first custom ARM-based Axion product, which provides 50% better performance and up to 60% better energy efficiency compared to legacy architectures, and will be used to run AI training and inference. 10 of the world's largest hyperscalers are deploying ARM-based chips for their data centers, including Amazon Web Services, Microsoft, and Oracle Cloud. NVIDIA also recently announced their Grace Blackwell superchip that combines NVIDIA's Blackwell GPU architecture with an ARM-based Grace CPU. This provides significant power savings compared to running a GPU alongside a legacy server chip. ARM technology provides similar power efficiency for chips in PCs, smartphones, automotive applications, and networking equipment. And as AI goes everywhere, we believe it will be enabled by our technology. Let me explain ARM's growth drivers more here. ARM will continue to invest a very large percentage of revenue in R&D each year. This will allow ARM to release new architectures faster, that will have higher performance, and that are much more energy efficient than previous gen architectures. The biggest advantage is this: ARM's new architectures, such as the ARMv9 CPUs, will generate higher royalty revenues than the previous V8 and older architectures. The biggest downside is this: ARM will likely need to invest at least 30% of its total revenue in R&D each year. This means we can expect that ARM's GAAP operating margin will likely stay very low in the single-digit percentage over the next several years. ARM's latest V9 architecture will earn a substantially higher royalty per chip compared to previous generation architectures. Morningstar estimated that ARM V9's royalty rates are around 4% to 5%. In comparison, ARM's previous generation architecture's royalty rates are typically around 1% to 2% for every ARM-based chip that's sold. Here's the important part. Customers are adopting ARM's V9 architecture much faster than previous generations. This means ARM's value will likely accelerate more going forward because of the very large demand for high performance and energy efficient chips in smartphones, tablets, autonomous driving electric vehicles, and now AI data centers. This is another growth driver for ARM. This is one of ARM's biggest competitive advantage. According to ARM, the company is still collecting royalties from ARM-based products that were developed in the early 1990s. This means ARM will continue earning royalties from the older ARM-based chips while earning high royalties from the much newer ARM-based chips. I want to show you this market share data here. It shows ARM's biggest growth markets going forward. ARM already owns 99% of the mobile market. Almost all iPhones and Android phones use ARM-based processors. In comparison, ARM is still underpenetrated in many other markets, such as consumer electronics, cloud compute, and automotive. Before, most of ARM's value came from the mobile market. Now, ARM has diversified to other major markets, such as automobile, cloud and networking, Internet of Things, IoT, and consumer electronics. The mobile market is very mature. It is still one of the biggest markets for ARM. ARM will continue earning high royalty fees from Apple, Samsung, Qualcomm, and many major smartphone makers and chip designers because these companies will continue selling more ARM-based smartphones and mobile devices over time. As of now, one of the biggest trends is bringing AI models to run locally on iPhones and Android smartphones. This means the major smartphone makers will need to invest in the latest ARM V9 architecture that pays high royalty fees to ARM. Also, the smartphone market is slowly recovering. Once the smartphone market recovers, we can expect that ARM will earn high royalty values from Apple, Samsung, and Qualcomm. Outside of the mobile market, ARM is aiming to capture 50% of the PC market in about 5 years. I don't think this is realistic at all. I believe ARM CEO is being too optimistic here. Here's why. The PC market is dominated by x86 CPUs made by Intel and AMD. Most Windows apps and PC games are developed for x86 CPUs. Many PC apps and games do not run well on ARM-based computers. x86 chips are supported by millions of developers and PC makers around the world. It's very costly and time-consuming for developers to optimize their PC apps and games for ARM-based chips. AMD and Intel will introduce more energy-efficient x86 chips to compete with ARM-based chips going forward. So it will not make sense for developers to spend the time and money to optimize their PC apps and games for ARM-based chips. Apple is the exception here. Apple controls both the hardware and the software, so it's a lot easier for Apple to optimize its apps for its ARM-based Macs. Outside of the mobile market, I believe the data center market will be the biggest growth driver for ARM going forward. As you may already know, power consumption is the biggest cost in running AI data centers. Many large hyperscale cloud providers and the largest chip designers are making their own ARM-based data center CPUs because ARM-based CPUs are generally much more energy efficient than x86 chips. Right now, ARM-based chips can often perform as well as x86 chips in many cloud computing and AI workloads. Google is making its ARM-based Xeon CPUs mostly for internal and Google Cloud computing workloads. Amazon already has its own ARM-based Graviton CPU. NVIDIA is already making the ARM-based Grace CPU that will be combined with 2 NVIDIA Blackwell GPUs. This will be the Grace Blackwell Superchip GB200. Also, NVIDIA's next-gen Vera CPU will be ARM-based. So all these ARM-based CPUs made by the largest data center customers will benefit ARM the most because they will provide higher licensing fees and higher royalty fees for ARM going forward. I want to show you this consensus forecast from Seeking Alpha so you will know ARM's expected growth rates going forward. ARM's revenue is expected to grow over 20% each year over the next 2 years. After that, ARM's revenue is expected to grow slightly below 20% each year over the next several years. In terms of EPS forecast, ARM's EPS is expected to grow higher than its revenue growth over the next several years. I think the biggest reason is that ARM is expected to earn high royalty revenues from its V9 architecture going forward. At the same time, ARM's operating expenses are expected to grow slower than its revenue growth over the next several years. I want to show you this intrinsic valuation model here. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate ARM stock's intrinsic value so you will know when ARM stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define ARM stock's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe ARM's revenue will grow at a compound annual growth rate CAGR between 20% and 25% each year over the next several years. This revenue growth rate is slightly higher than the consensus revenue forecast I showed you earlier. I'm using a 30% free cash flow margin here. This free cash flow margin is higher than before because I believe ARM will become more profitable going forward. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that ARM's value will grow at a CAGR of 20% over the next several years. Then ARM's intrinsic value should be around $111 billion for the entire company, or $105 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that ARM's value will grow at a CAGR of 22.5% over the next several years. Then ARM's intrinsic value should be around $123 billion for the entire company, or $116 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that ARM's value will grow at a CAGR of 25% over the next several years. Then ARM's intrinsic value should be around $136 billion for the entire company, or $128 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, ARM's intrinsic value should be around $170 per share. I also used a 4 sales valuation model to estimate ARM's intrinsic value, which should be around $109 billion for the entire company, or about $103 per share. If we take the average of both valuation models here, I believe ARM's intrinsic value should be around $110 per share. Just to compare, Morningstar gave ARM a much lower fair value of $66 per share. This means I believe ARM holding stock is substantially overvalued now. The 4 PEs I showed you earlier also suggest that ARM stock is likely greatly overvalued now. So will I buy ARM stock? My answer is no. I'm not planning to buy ARM holding stocks at the current price because I believe it's substantially overvalued now. I will only consider buying it if it dips below my intrinsic value. If I buy it, I will only buy a very small position. Overall, I believe ARM has a very large economic moat, especially in the mobile market. I believe ARM will have the biggest growth opportunities in the AI data center market because the largest data center customers such as Amazon, Google, Microsoft, and Meta want to use ARM-based CPUs that are much more power efficient than x86 CPUs. I don't think ARM can compete well in the PC market because it's too expensive and time-consuming for developers to optimize their PC apps and games for ARM-based chips. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.